a siren song for investors seeking safety, stability, and a hedge against economic uncertainty. Yet, despite its enduring appeal, a surprisingly large number of people consistently buy gold at precisely the wrong time, undermining their potential returns and exposing themselves to unnecessary risk. What are the hidden traps that ensnare these well-intentioned investors, and how can you avoid making the same costly mistakes? Welcome back to the Gold Protocol. Today, we're dissecting the common pitfalls that lead investors to buy gold at inopportune moments, revealing the underlying psychological and market forces that drive these behaviors. By understanding these patterns, you can equip yourself with the knowledge and strategies to time your gold purchases more effectively, maximizing your potential for long-term financial success. Defined missed opportunities and elevated risk. Buying gold at the wrong time refers to purchasing when it's overvalued, driven by hype, speculation, or short-term sentiment. This leads to diminished returns and increased vulnerability to price corrections. Buying at the wrong time can diminish profits and affect investment goals. Buying at market peaks. Purchasing after a significant price surge risks buying at the top, before a potential decline. Investing when everything is going high affects investment results. Ignoring fundamental analysis, purchasing without considering economic factors or supply/demand dynamics leads to buying when the market is overvalued. Proper gold strategy begins with doing economic analysis. Human psychology plays a role in driving mistimed gold purchases. Emotional biases can cloud judgment and lead to impulsive decisions. Fear of missing out, FOMO. FOMO drives investors to buy after a price increase, even if the fundamentals don't support it. This fear can create bubbles and will drive investors to be illogical. Panic buying. During turmoil, fear drives investors to gold as a safe haven, pushing prices to unsustainable levels. Fear will also influence how prices appear to be in the financial markets. Greed and the greater fool. Relying on the belief that someone else will pay even more. This speculation can inflate bubbles and drive gold into highs. Market dynamics and misinformation. The role of media and experts. The media and certain experts can contribute to the problem, often amplifying fear and hype and promoting inaccurate information. Experts are sometimes wrong and have affected how consumers view investing. Sensationalist headlines. News outlets often focus on worst-case scenarios, creating undue fear and driving investors to gold at the wrong time. It is important to view financial investments as a business decision. Self-proclaimed gurus. Certain advisors promote gold aggressively, exaggerating its benefits to generate commissions. Listen to professionals and avoid biased opinions on investments. Effectively avoiding these pitfalls requires a disciplined, analytical, and long-term approach. You need to protect yourself in the long run and make sure you are making wise investment decisions. Fundamental analysis. Focus on economic factors to assess the fundamental value of gold. Economic factors will greatly influence the state of global finances. Dollar cost averaging. Invest a fixed amount at regular intervals regardless of price. This strategy helps smooth out price fluctuations. Regular small investments can add up over time to create significant value. Contrarian investing. Consider buying when it's out of favor, when others are selling and valuations are low. Going against the grain in some instances can be helpful and create profits. By understanding the psychological traps and market dynamics that lead to mistimed gold purchases, and by adopting a disciplined, analytical approach, you can significantly improve your chances of timing your investments effectively and achieving long-term financial success. For more insights into smart gold investing, subscribe to the Gold Protocol. Thanks for watching.